I did my first like net worth and budget calculations. And I'm like, what if I sell everything and go into this passive income stuff? And I realized that by doing that, I could quit my oil field job, which was a job I really despised. I never saw myself there long term. It was just not a good fit for me.
Travis, welcome to the show today.
Hey, thrilled to be here. Glad to be back. It's been a few years.
It's been a little while, and let's look at your backstory. How did you get started with investing passively in syndications? Because there's a lot of people listening to this stuff like this is pretty cool. But I've always invested in the stock market. And how did you get started with syndications?
Sure. I think, the story could be said a lot of different ways, but I think it starts from my upbringing and childhood. So my parents were always about this value add stuff. They were not investors in value add multifamily or anything, but it was all about, let's buy a used car that's got some issues and let's fix it and make it worth more and try to maintain our value in it, or buy used clothing and, resell it for the same price you paid, that kind of stuff. So I was always fascinated with money, but more from a budget perspective. And still, I started thinking as I got older about, let's just say I was the best budgeter ever and I made $10,000 a month in W-2 income, which would have been, a great achievement for me as a child, to strive for. Well, you still got to pay for housing and food and expenses and lifestyle and travel and insurance, all these things. And so even if I clipped coupons my whole life and I saved as much as I could, I mean, my highest and best might be $3,000 or $4,000 per month that I could put away. And if you're just sticking that in the bank and you're just waiting until retirement, you're going to get eaten up by inflation. It's just quite frankly never going to be enough. And you're going to have to make a ton of sacrifices your whole life. So I got turned on, like so many people, with the Rich Dad Poor Dad books and that kind of stuff, into real estate and taxes. And it was just a whole new world for me to explore. And so the first thing I did, Michael and Garrett, was house hacking. So I bought a 2-bed, 1-bath, and it was in a college town. It was 2 miles from Colorado State University. And I had just come out of college. And so I knew there was a demand for a furnished place that was a rental. And so my mortgage was like $640 a month, and I was getting $600 a month in cash flow that I didn't have to work for. So that was like the wheels turning right there. And I thought, how do I turn this 600 and times that by, 50 or 100? How do I do this over and over without having 100 roommates? And so that led to, fix and flips, buy and holds, vacation rentals. I did all kinds of stuff in single family until I burned out. And I think that's the story for so many people. You don't realize how active that really gets until you're, 7 properties deep. And all of a sudden it's like you're running around. I had a W-2 job. I was working 100 hours a week. And then I'm having to manage all this on the side. And man, I had zero time for family, for friends, for dating, for travel. I had no time in my life. So for me, it was all about what I call time freedom and the ability to do more with my time. And so I ended up selling, I'm just shortening the story for you guys, ended up selling all my single family homes, including the house I lived in. And I ended up going into real estate private placements, which I found out about through a couple mentors in a local real estate meetup group in Boulder, Colorado. And I just did one at a time, minimum investments here and there, started diversifying, and realized that's a real thing that people can do. To your point, I always just thought about stock market or single family home. It's real estate or it's stocks. And that's where the world ends right there. So I've learned a lot over the years, but for me, it was about freeing up time and having a life and not just living to work.
Yeah. And you then made a transition to working with Ashcroft Capital, and you're actually managing investors. And I think your background is awesome because it puts you in their shoes. So when you're talking to a prospective investor,
yeah,
you kind of know what they're thinking, what they want,
yeah,
what they're maybe concerned about. And tell us a little bit of background on how that came about to your current role today.
Yeah. Well, the first thing I did when I started getting serious about real estate and cash flow, and I got the bug, so to speak, is I did my first like net worth and budget calculations. And I'm like, what if I sell everything and go into this passive income stuff? And I realized that by doing that, I could quit my oil field job, which was a job I really despised. I never saw myself there long term. It was just not a good fit for me. And the first thing I did, ironically, I went to go work for a huge brokerage house, got a Series 7, 63. I wanted to do stocks, bonds, and mutual funds to start learning about that too. So I wasn't just a one-trick pony. Then I realized real estate's really where my passion lies. That's really what I want to go with. worked for a small syndication startup group for a few years, helping them with investor relations because that's what they needed. And because they were a startup, they just needed somebody. So it just kind of like fell into my lap that way. And then I had been investing with Joe Fairless and Ashcroft for a number of years. I was an LP in a lot of their deals. And Joe had his firstborn daughter, Quinn, and I knew he didn't want to be out on the road and doing all these travel events and conferences. So I said, look, this is my passion and I love educating people on this stuff. It's what I do full time. Let me take that off your plate and call me whatever you want to call me, but I'll just get out there and I'll do podcasts, webinars, meetups, whatever you need. And that's kind of how it came to be with Joe years later.
Yeah, it's funny. I think I got together at Dealmaker Live a couple of years ago, and he was like talking. I was like, Joe, you're still talking to all the investors? He goes, yeah, it's really important. I was like, well, I'm sure it is, but it's not really the best use of your time, And
Yeah.
so I'm glad he brought you on because you now can focus on this. So let's talk about some of the best practices, right? People,
Sure.
What are some keys or how you take care of your investors? What do you think is the most important when you interact and deal with potential investors or even existing investors?
Sure. Well, I think you hit the nail on the head earlier when you said, I try to come from the perspective that I am an LP investor myself, not only with Ashcroft, but other groups too. So I can kind of come from that angle. This is what I see, and this is how I think it stacks up and my thoughts on it. Again, never, recommending or endorsing, but just having that small time chat, I think is really useful. Also, a thing I've learned over the years from the brokerage house to the startup to here is not to be a product pusher. You don't have to be a salesperson, and in fact, I'm not, and I never will be. You try to be solution oriented. I try to ask people about what they're trying to achieve, why they're trying to achieve it, and I start tuning the conversation towards that direction. Right? I'm trying to find a solution, if possible, to help solve the problems that they have or to help them achieve what they're trying to achieve. I think that's really key for people, and not just to say, hey, I'm Travis Ashcroft, here's our fund, it's monthly distributions, here's the returns, do you want to put 100K here? That's just not a good approach. It doesn't usually result in a high ROI.
So talk about some of the problems that potential investors have. It's interesting that you mentioned that, and
Yeah.
Some probably because they listen to Joe's podcast or already have syndications in their brain, and some know it more than others, but fundamentally, what are they trying to do? What are they trying to solve when they talk to you? Yeah, and so it's interesting. I would sometimes gauge our investor sentiment, like right now, for example, and it kind of ebbs and flows. For example, COVID wigged people out. How do you see investors react to certain things? Like just take it now, for example, right? Like now versus maybe 6 months ago, or maybe even 2 years ago. What is on investors' minds right now?
It's funny how all asset classes really tie in together when things go in cycles or have their ups and downs. I think our human psychology is all really the same, So right now reminds me so much of the summer of 2020 when the pandemic onset. You see everyone's personality type start coming out a lot more, and you've got a lot of people, hey, I'm on the sidelines, I'm going to wait and see. You've got some people like under the impression that, hey, as interest rates go up, that means that they're repricing and discounts on the multifamily. So I'm going to keep investing and I'm going to kind of dollar cost average through the downturn. And you've got everyone in between, but there is a lot of money, I think, still sitting on the sidelines. And so as markets recover, like we saw in 2021, and everyone's just buying everything and everything's just going through the roof, then it's kind of the opposite. Everyone's just throwing money everywhere, and maybe not doing as much due diligence as they should. So that's what I see. And what I subscribe to is kind of what Seneca said, 2000 years ago, Roman Stoic. He said, we suffer more in imagination than in reality. And I think a lot of people are always think worst case scenario. Oh my God, we're going in recession. It's going to be 2008 all over again. I remember what happened. I lost my home. I lost my job. My 401k got cut in half. It's happening again. We're due for it, but it doesn't always pan out that way. And if you're educated in these types of asset classes that we both invest in, there's a lot of bullish case to be made for them, I believe, especially in times of recession. So something to keep in mind.
Yeah, I definitely agree with that, Travis. I think that, it could go either way. No one really can predict the future realistically. I think going back to your comment on 2020, at that point it was doomsday for the world, right? Like
Yeah.
all the debt funds shut down essentially, and everyone's like, oh, this is it, it's here. And then followed by a complete turn up in literally everything,
Yeah.
due to inflation, and apartments were impacted in such a positive way in a short amount of time, and everyone thought it was doomsday. So you don't really know. And I think that the core of apartments, the core situation is that people need a place to live.
Yep.
And it's a strong asset class being comparable to really any other. It's one of the strongest that we're in right now. And so I
Yeah.
think, getting people more exposed to it is so important. So I'm just curious, how do you guys attract more investors, and how do you get the word out so that they get interested and come and talk to you?
Yeah, it's a great question, and appreciate your comments, Garrett. We've, like everybody in the space, we've tried a lot of things, and a lot of things haven't stuck, so we're always it's a moving target. I'd say some of our most effective stuff has been doing property tours and in-person events, meetups that we're the host of, a happy hour. We've done these road shows because, or even being at a conference, anytime you can get face-to-face, that whole know, like, and trust really skyrockets, right? You really start to know someone quickly, and not just over a batch of emails that have been in your inbox for the last year or something like that. I just got off a webinar before we're doing this call. And so there I'm speaking with a bunch of, accredited investors. We've done medical events that way. So we've done a lot of different stuff. And I'd say a game changer for us was moving to a 506C offering where we could generally advertise our deals. I think that gave us a ton of exposure, and simultaneously we lowered the minimum investment to 25,000, which allowed a lot of people to toe dip when, like 60% of our investment today that we raise is returning investors. And I think, that average, or not that average, that person who steps in at 25 ends up at 100 plus, in the next year or two. So,
Well, that's a really interesting comment. So we actually have gone the opposite. We've gone up to minimum, and it's helped us get through raises faster.
yes.
I'm curious.
Yep.
Yeah, I'm curious in your guys' methodology and going down to 25. How are you getting them, the 25K investor, to go in for 100?
Mm-hmm.
And how do you fill up your deals only going with a 25K minimum?
Yeah, it's a good question. Well, we have over, I think, 3,000 some investors at this point. So a lot of it, just comes from repeat, like I said. But so how it works is we're doing funds right now. So someone can step in at 25 in January, let's say, and then wait till July. Now we've acquired several properties, right? Then they can step in with another 25K if they want. And then they could step in with another 25K if it's still open in November. So they end up, with 75 just over the course of the year, and not having to call up 100K right off the bat on day one, take it or leave it. We're about to close the deal. The other benefit that I found is we used to do one deal at a time. And it was really unfortunate to have a great investor that's like, man, I'm itching at the bit to do your next deal. I can't wait for it. And then that deal comes up and they have some circumstantial issue where their capital's tied up, or it's like, oh, the closing to my home got postponed a month, so I don't really have the money right now, but they will have it like 2 weeks after we close. And so the fund allows them to get into the deal and not lose out on it. And so we were getting, a lot of deals funded within a couple of days when we did one at a time. So I think that's the other reason. And the last point I'll make to that is I believe our average investment size is still around like 125 or something like that. So just because it's a 25K minimum doesn't mean everyone's coming in at 25K. Most people aren't. It's just for those that are like, I would do 50, but I just have 25 right now. I'll have more later on.
You mentioned some of the differences of raising money for one deal at a time versus a fund.
Yeah.
And you just mentioned the downside of that. But how is it different raising money for a fund versus raising money on a deal by deal basis? I mean, one advantage from your perspective, you have a deal, you have a lot of excitement, you have this webinar, there's an end, and people kind of rush to try to get in. And a fund is always open. Yeah, well, I can get in now, or maybe later, or maybe never. There's no urgency. So how have you guys found raising money for one versus the other? Kind of some pros and cons, maybe.
Yeah, no, and it's totally a fair question. I'm not the guy to stand up here and say the fund's the only way to go and it's the best and all that kind of stuff. I like both, to be honest with you. And to your point, you can create a lot more sense of urgency and excitement and hurry up. It's going to fully subscribe soon, and that really does work. To even me, knowing my psychology and how it works behind the scenes. So to me, here's the big picture. With the fund, I'm sorry, with individual deals, I felt like it was constantly like shove on the gas and then pump the brakes and then shove on the gas and pump the brakes. We got new PPMs, new subscription agreements, a lot of inefficiencies, right? And so it's always that stop and go, sorry, you missed out. How about the next one? And then that doesn't meet their criteria. And then, it's just inefficient. I think when you get to the point where I think we're raising like, I don't know, 120 million this year. I mean, when you get to the point where you can kind of raise that amount of capital, maybe one deal at a time where you're subscribing them in a day or two is a little less efficient than buying a portfolio or maybe even a fund in that sense.
And you said repeat investors. If you have a fund open and let's say you're doing a whatever $50 million fund and someone invests the minimum 25, what induces them to keep investing with you and invest, like you said, the 75 versus simply waiting until the next fund? Right. That's one advantage. If you're doing a deal, let's say every quarter, and you get the minimum from the investor, they're going to put in the minimum, 4 times a year. Versus with a fund, for example, they're like, yeah, I'm just going to put my minimum in, and then next year I'll put the other in, and meanwhile they'll invest somewhere else. Or how are you inducing or encouraging people to keep investing in the fund?
Yeah. So to your point earlier about kind of that excitement of each deal. So we still do a webinar presentation on every deal that we put in the fund, and an email still goes out, and it's still a first come, first serve offering. And, we have 2 different share classes, and our A shares always subscribe first. And so there's still elements of sense of urgency. And of course you do get the types, to your point, that are, well, I'll just wait around till it right before it closes and try to get in, or I'll just do 25 and next year maybe 25. But what I've found to be more of the case is it's really about the investor's liquidity at any given time. And again, back to the one deal at a time, that was just the tragedy, is when someone's sitting on 100K burning a hole in their pocket, we don't have a deal. So they go invest with our competitor, and then we do have a deal. And it was like, oh, whereas they would have had an opening, and they know with a certain amount of certainty that they've got a leeway of several months, at least first come, first serve, that this fund will be open. So again, pros and cons, but that's the macro.
But overall, you seem like you like it then better than before, it sounds like to me. Garrett, you had a question.
Yeah, I was going to say, so I've heard both sides of this. If you have a lot of like a volume of investors, do you think it would make more sense to have a fund for that type of an environment as an organization versus if you have, let's say 20 bigger guys that are repeat investors on individual deals? I'm just curious your take.
That's a good question. I don't know, man. You could play it either way. I want to address some downfalls to a fund too, because I don't want to sound too biased towards just because we do a fund. So with a fund, you're having to put more trust in the operator to do what they say they're going to do. We say we're going to acquire 6 to 10 properties this year. We're going to raise 120 million. We're going to be in these markets. We're going to get this kind of financing. Yeah, that's a lot of trust. If you invest in January before we even have a deal, that all that stuff's going to pan out. At least you have the certainty with one deal. You can go visit that property yourself. You can do your own due diligence. You can master and understand everything you need to know about that one deal, instead of putting 100K in and saying, boy, I hope they buy a good one. So it's more like, I like to paint the parallel between the stock investors. It's kind of the difference between, stock picking and looking at individual fundamentals and spreadsheets and like, yes, I'm going to buy, this company for these reasons. I like it a lot. I'm going to pass on this company for these reasons, instead of just being an index fund investor and saying, I'll buy the S&P index and, I'm busy over here. I just want to be passive. And that's not my expertise. I'll let someone else handle the management. I just want to grow my portfolio over time. So we have a lot more of that mentality where, once they know, like, and trust us, once they become a repeat investor, once we show them, we underpromise and overdeliver over and over again. That's always our mantra. They tend to put a lot more trust in at that point. So it's not always the first new investor with the 25K that's in that boat.
Now, you mentioned repeat investors, which is critical as you build your business. And obviously one factor of that is that you actually deliver, you deliver on your promise of whatever the returns are. But I'm curious to see what else you guys do to take care of your investors, above and beyond the actual returns of it. What do you guys do on a routine basis to take care of your investors, to engage them so that they continue investing with you over time, and even more importantly, telling all their friends and bringing them to you? Like, what are you guys doing as a best practice?
Sure. I think, quite honestly, we could do more in terms of promoting, doing referrals. So we've done a couple of things. We did a whole testimonial page. There's a whole compliance movement where that's now something that you can do. So we have a whole testimonial page that you can sort by either geographic region. So say you're in Atlanta and you want to meet up with some Atlanta folks, or at least hear their stories of why they invest with us, or say you're a medical doctor, you can sort by that and listen to what medical doctors say. So I use the crap out of that page, as I'm, especially, those defined, I'm an airline pilot or whatever. That's a great resource and tool. We have also, I didn't address this when I was talking about me being IR. I was the first guy to come on after Joe. We've now built a team. So we have an investor relations manager, and then he has a team built out underneath him. So we're able to do things that we weren't before, like more of a white glove service. Here's the person that's your point of contact. They will take care of everything. They're always available on email, blah, 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 phone, text. If they aren't, it's auto forwarded to another rep who will get in touch with you within 24 hours. See, we couldn't do all that stuff before, especially when Joe was the guy and he goes on a week-long trip. Who's taking the calls? You know what I mean? So I think you have to kind of scale into some of this stuff, but that's some of what we do, is trying to make a easier and more streamlined process for people.
What other things do you guys do? I think you mentioned earlier, you do some kind of events for your investors. Do you send them gifts at some, what else do you guys do in addition to what you just mentioned?
Yeah, so we were doing, and we still are, by the way, this road show. So we took a geographic map of where our investors are, and of course, like anyone, they tend to be near, big city center hubs. You've got Phoenix or Orlando or Cincinnati, where Joe lives, or Dallas or whatever. So we did this whole road show where we go out, we'll do a presentation, we'll do a happy hour, free food, free drinks. I do property tours. That's my favorite thing to do. So I take care of all of Florida because that's where I live. And, we own in Jacksonville and Tampa and Orlando. And again, I'm just a big fan of in person. There's webinars I'll get on sometimes with 1,000 people, and you'd be lucky to get one investor there, but you show up sometimes to a property tour with 3 people and all 3 invest. It's insane to me, the conversion. And it's not always that way, but I'm just painting those extremes. So yeah, I try to get in front of people in every outlet I can. You'd be surprised at where people are. I did a podcast like a month ago, and I just under my breath was like, I have this financial statement I use, and I've had it for years, and I think it's a great mother. Like, if anyone wants it, just reach out. And I had like 20 messages on my Instagram and my LinkedIn and my email. And it's like, man, like, I didn't think that many people were on Instagram that was into this kind of stuff. So you just never know. I'm a big fan of just putting content everywhere, seeing where it sticks, and kind of doubling down what works.
And what are you guys doing on content? Is it something that you're doing or someone else in the organization? How are you attracting new investors?
Yeah, so we've got a whole marketing team built out, just brought on a brand new director of marketing last week, actually. So we'll be making a lot of changes, I'm sure. And again, like everyone, we've tried a lot that hasn't worked as well. But, banner ads and Google stuff and Facebook ads and LinkedIn stuff, Bigger Pockets ads. We do conferences. I do these webinars. So, we're out there trying to do what we can, but, I can't recommend any one of those sources as being like the end all be all, and that's how it's done. It doesn't work that way.
I was just going to ask you for the silver bullet, Travis. Come on now.
Get an Instagram as big as the old Cardone guy, right? And do that. I don't know.
Brandon Turner swears by it, of course.
Oh yeah, he's another great example.
Possibly work. It sounds like these road shows, they're probably a lot of work, but it sounds like they work pretty well. What else is working for you?
Yeah. Yeah, they do actually. And what's cool about it is, again, we have a sizable team now. So we'll call it 5-6 people total that can actually host these things. And sometimes it's just a property manager at one of our properties. So they're not hard to do. It's usually one person flying out with a hotel for a night, and it's not a huge expense, and then food and drinks and that kind of stuff. So I can't give you all our secrets, Michael. What is this, man? Is this even going to air, or are you just picking my brain? What's going on?
That was the point.
It's just,
This isn't even a podcast, is it?
this is actually
I'm getting
not a
interrogated.
podcast. It's really, yeah, exactly right. So
Yeah.
what's your, Travis, what's your advice to, and you come across a lot of other syndicators, and,
Yeah.
what are some of the mistakes that you see others make with regards to investors? And so, in other words, what's kind of your parting advice to syndicators who are, trying to grow their businesses?
Yeah, I think that well, first of all, you've got to find a way to put content out there that lets people know who you are. And I think one huge mistake is trying to pick one platform and say, all right, we're launching a YouTube channel. That's what my company is going to specialize in. But you got to remember, a lot of people don't get on YouTube. They get on Instagram. Well, if you're not there, you missed them. If you're not on Facebook, you miss them. If you're not on Bigger Pockets, you miss them, So you got to get your content and your story out there. And I think, circling back to one of the points I made earlier about not being a salesperson, like, I can't tell you how much garbage I get on LinkedIn every freaking day of just, here's my deal, here's the returns, here's the link. I don't click on the link. You don't know me, I don't know you, that kind of stuff. Or those cheesy, I love your profile, want to connect. I mean, come on. You got to get to know people. You've got to ask them questions, I think, and you have to be solution oriented. I really think that's huge. And then once you get people in the door, it's the under promise and over deliver, and doing what you say, and being available and responsive, and all the things that I'm sure we all know at that point.
I love it. Travis, how can people find out more about you and Ashcroft?
Yeah, I give away 15-minute calls. It doesn't have to be about Ashcroft, just talking about multifamily, LP stuff, whatever. That link is ashcroftcapital.com/Travis. Got downloadable resources there, a lot of things that you can check out. But again, not a pitch just for Ashcroft, is how I connect with people in the world of every shape and size, gender and age.
Awesome. Travis, thanks so much for being on the show today.
Thanks so much, Michael and Garrett. Appreciate you guys.